So we're talking about capital markets and commodities, and just very quickly an introduction to myself. I'm Shawn Duthie. I'm a director with Control Risks, which is a global risk advisory. We work with a lot of commodity companies as well as traders and everything to provide security, intelligence, political risk, and a very diverse range of services for people to fund risks, but as well as opportunities in Africa and around the world. But I think, more importantly, we have a very good panel. I would do an injustice to try and introduce you guys. So let me pass it over to you guys to introduce yourselves, and then we'll get on to the questions. Hirander, you want to go first?
Hi, everybody. And actually, it's probably not the worst panel before lunch. After lunch, it might be even worse, but maybe an audience poll later. So my name is Hirander Misra. I'm the chairman and CEO of a company called GMEX Group. It's a global market infrastructure company, and we have a subsidiary called 013 that started with carbon credits, but is a investment financing platform and custodian now for a wide range of commodities assets.
Good morning. My name is Remi B. I'm the Chief Investment Officer of Kessner Capital Management. I am as well a managing partner of Atria Trade Investment. Long history with Africa and commodities. I was born in West Africa, raised in East Africa, and I spent the past 25 years trading commodities in Southern Africa. More recently, I moved to fund management and finance, trade finance, and I have a personal interest into digital ventures.
Hello, everybody. My name is Rutendo Hwindingwi. I'm the founder and CEO of Tribe Africa Advisory, which is a niche advisory firm focusing on business development and working with multinationals and their leadership in navigating the African landscape from a business perspective and harnessing opportunities.
Great, thank you all. Now let's kick off, and I think a lot of the talk these past 2 days has been about the geopolitical environment, about how we've had a lot of very volatile geopolitics, but also that has impacted the commodity market. So if we're looking at fundraising, if we're looking at capital markets, how have capital markets been able to adapt to the increasing complexity and volatility in these global commodity markets? And I'm going to open this up to the floor. You guys can have a discussion. Don't wait for me to come to you. We can just have a bit of a discussion. I know, Hirander, do you want to go first, and we'll go from there?
Yeah, all right, I'll break the ice and kick off then, Shawn. So it's interesting. I mean, I come from about 28 years in capital markets, initially in Europe. We also have a fully regulated securities exchange in the Seychelles called CETDEX within the group. And really, the focus, the opportunity we saw a number of years ago was looking at, I mean, there's not a lot of liquidity in African securities markets. I mean, even for kind of exchange-traded commodities and others, the Swiss market and SIX, there's a lot of opportunity there, and there's a number of structured products. But we really saw the opportunity around hybrid securities, looking at kind of Africa's output. Initially, it was kind of vanilla security tokens, but more recently, we've seen a massive opportunity around commodities-based instruments. And when we say hybrid, it means, okay, how do you harness traditional capital from public markets, but also now there's huge pools of digital capital available. We've heard from some panels here previously about speaking about stable coins and the rest, but Tether now as a stablecoin issuer has $180 billion of reserve. About 95% of that is in US Treasuries, that short-term US Treasuries that yield 5%. But as a company, they're one of the few in that space that have got the fact there's a huge opportunity both to generate yield and outright return on the commodity side, and they've invested into mines that yield gold and output there, also into an Argentinian agri company with traditional output. So the opportunity here is, I mean, when we talk about tokens, everyone speaks about whether they're different or there's financial terms that might be different, but actually it's essentially the same. It's finance. And we're seeing a massive opportunity on the digital side for real-world assets. And for the first time, digital markets and physical commodities markets are coming together because this demand is unrealized. And really, it's going to be about, Shawn, you and I were talking about it in the break, source to sale provenance, provenancing these assets, bringing them into structures, whether they're securities on the basis of trust structures that you can then securitize. And the process is essentially the same, albeit the technology and means are different, whether you list them on traditional capital markets like Switzerland that's got a big regime, or digital capital markets like we're doing. And we'll delve deeper in this, but hopefully that sets the context.
Thanks, Hirander. Remi, good to hear from you.
Yeah, thanks for mentioning Tether. I was basically recently invested in the biggest actually private landowner in South America, and that's actually draw a picture. What I've seen, I've seen over the past decade. In 2008 and 9, during the first financial crisis, we saw as well a big impact on food security. And at the time, I was dealing with big wheat buyers around the world, and these guys had a very complex strategy of derivative, management for price risk. But when the problem occurred of this financial, crisis, they realized they didn't have the physical commodity, and this was a big eye-opening for these entities to realize that the physical side of the commodity was king. In 2020-21, during the pandemic, same thing happened. We all saw a massive disruption in supply chain, and same thing. Suddenly people were crawling to get hold of physicals, because of the length of time it was taking to move from A to B, to finance, to produce, to all these commodities. What we're seeing today is not that different. We moved away, obviously, from the last crisis, but we are in a time of high disruption, call it climate change, political disruption, war, tariff. I mean, that's a great opportunity normally for traders like me. We love chaos because that's where we operate. But at the same time, you see a pattern against today, which are a lot of investors are turning back into physical assets. We see it in infrastructure, we see it in obviously minerals, but we see it as well in agriculture, and we'll talk about it. Certain entities, sovereign funds, basically entering the game of physical ownership, or owning a stake in physical traders. And obviously, this is just the beginning. We're seeing this physical moving slowly but surely into digital, and real-world assets, tokenization, are the next frontier for physical commodity. And very soon, digital will become the new physical. I've got no doubt about it.
So I think from my side, just looking from the lens from an African perspective, I think, totally agree with my colleagues. I think from a disruption perspective, huge disruption. I was reading the other day, I think London, the London Stock Exchange, just in terms of commodities, they were creating new tools or new structures to actually accommodate greater investment by African countries onto the London Stock Exchange. And the reason for that, 10 years ago, 20 years ago, that wasn't a big thing. There was enough commodity transactions and inflows that were happening globally. But when you see them coming to, and remember, Africa, we're only 3% of global GDP. We don't have a huge component, but what we do have a lot of raw materials, a lot of raw capability, and that needs to steer, especially when you're looking at the future of technology, the future of ESG. So I think from an African perspective, that disruption is a huge opportunity for other countries, for other companies to capitalize on the opportunities we have with regards to the global disruption. And coming back in terms of technology, I think a big play, and I totally agree with you, I think the difference between your traditional commodities and the digital opportunities that are there is that it's not limited by the traditional borders. The digital landscape is borderless, and that creates another dimension of risk and opportunity as well.
And just one point on the digital side as well. I mean, it's by no means an answer to all questions as well, because when you've got something asset-backed, I mean, we've still got the physical world, right? As much as we'd like to dream we're all in the metaverse. So the thing is, the gold's got to be in a vault, or the commodities have got to be in a warehouse as well. So one of the challenges we found, and I know some of the previous panels yesterday tried to address this, is how do you keep the digital world synchronous with the physical world as well? Although that said, it's not an insurmountable challenge, whether it's gold in vaults, we can account for that as well, and the supply chains and inventory management has become key. The point about London Stock Exchange is a good one, because we recently hosted an event with the Indian government at the London Stock Exchange, and they realized, take carbon credits, right? It's when we talk about provenance, how is this piece of air valuable versus this piece of air that's junk? And we don't even know where the food on our plates come from. We speak about food security, but we've lost that link with where our food came from and provenance. So I think a lot of the technologies on the digital side allow us to harness this. And then in terms of capital markets, investors can't really invest into a carbon credit. It's not an institutional product. But then when you package that, turn it into a structured product, like there's one we've been working with a South African issuer called Orpheus Capital onto the Swiss exchange, all of a sudden you have a daily net asset value. The instrument is now listed, it's settled in the Swiss International Central Securities Depository in Euroclear, and institutional investors can come into it. The LSE have taken a different approach, where they've then said, okay, carbon and other agri projects can't really be financed effectively. There's a lack of capital. How do we harness public markets? So they've actually kind of created or worked with issuers who have got SPVs, listed those SPVs, and then the return is on the back of the cash flows from those SPVs.
Okay, I'm still trying to get my head around how all of it works, and maybe you both can help on this, because I think, yeah, there has been a push away from the traditional capital markets to much more digital use of blockchain, tokenization. I think you have a gold project for this. How does it actually work? How does the tokenization, the blockchain actually work to kind of enter into those capital markets, and how does it affect those capital markets?
Yeah, I mean, it's interesting. We've got, sometimes it's learning by doing. So it was interesting. The first time we did this was in Africa, and it was a little bit ahead of its time. The Mauritian government said we want to launch a gold exchange. So we ended up, on the private sector, launching something called Mauritius International Derivatives Exchange, Mindex. It still exists today, but we no longer own it. And then we realized, Mauritius is quite well protected. The Indian Navy and others are there. Then we realized, actually, there was a perfect site in the free zone. It was by the private jet terminal, where you could effectively land and park a 737. And really, we'd partnered with Brinks at the time to create a physical vault refinery, and got all the approvals. But then there were some ease of business issues. It's not always, some of the panels previously spoke about some of that in South Africa, but some of these things arise elsewhere. That kind of took us to Seychelles, but you couldn't really do gold there. But actually, fast forward to present day, sometimes it's learning by doing. Securities, tokenizing Apple stocks, and you see a lot of euphoria around tokenizing real estate in Dubai now. I spent a lot of time both in Dubai and Singapore. There isn't really a need to tokenize Apple stocks, because one, when you're tokenizing them, actually you've got a range of stock in a custodian. It's ring fenced, and actually the markets are quite efficient. The Nasdaq announcement, I think, is complete nonsense anyway, and it was more to get on the hype cycle. But the big opportunity is on commodities, and so an issuer came to us with 43101 SGS valued gold assets to the tune of, after a haircut, 420 billion. And we decided to tokenize those. But actually, there was a lot of work, because everyone thinks there's a lot of tokens out there, and they're complete Ponzi schemes. But you had a lot of work that you would in traditional markets, as you were speaking about, to structure this properly, set up trust structures, put the assets into trust, have a governance structure, become co-trustee of those assets, and then from there back the assets into an SPV, and then in turn digitally list on our market, and then effectively securitize the tokens. And all of a sudden, it became a security token. Now, initially, it was very slow, but now we're seeing demand emerge for that. But we've had to, for institutional investors, put proper wrappers around this as well. And actually, the market's going to be very much hybrid, because traditional investors, let's say we're engaged with the Chinese, they want yield, they want traditional instruments, they don't really want to touch tokens. Other investors, like the Tethers of this world, will love a play which gives them way more yield than 5% in US Treasuries, and they're going into it. And some investors like pure play kind of outright return tokens. So it's horses for courses. Private capital, public capital isn't going away, but digital capital is going to add massive capacity for mining investment and also carbon credits and other projects as well.
Just to add to that, we already are pre-token, let's be honest. I mean, most of the transactions we are taking place in Africa today are based in very often on a collateral, which will serve, as a guarantee. I mean, today you rely on pretty much on paperwork, the same which was used probably 1 century ago, which is why we can't wait for the next wave of revolution to come. But that being said, you've had some improvement in terms of the process. Today, you have electronic bill of lading, which are being more and more used, to facilitate transaction between stakeholders. You have, for futures market, for example, you have electronic silo certificates, which are basically done online. No, they're not tokenized, but they're already, digitalized and tracked, so that there is a kind of, very high level of certainty and security attached to it. Obviously, tokenization is the next level. It's happening as well on the agri, and when we talk about innovation, I would like to share a little story with you about one initiative I was involved with last year involving agri tokens in Kenya.
I think just to add on to that, in talking about disruption, digital technologies, I'm just bringing it again from an Africa perspective where the chaos and the opportunity reigns, as my brother has highlighted here. I think the other day I was highlighting now I think it's in Nigeria, the participation of adults in the capital market. Nigeria, obviously West Africa, big player with regards to commodities, with regards to opportunity, with regards to technology. But I think it's estimated only about 3% of adults participate in the traditional capital markets. Whereas when you look at your crypto, your blockchain activity, it goes up to the 50-60%. And the reason is because of a regulatory framework. An ordinary average person to participate in the capital markets, there's a regulatory framework, there's a structure that's tried and tested. It's quite difficult. But when you go digital, it's easier. It's more seamless. And I think it just when you extrapolate that from not just an individual perspective, but into an ecosystem of from a corporate perspective, a government, public sector perspective, you can actually see a huge opportunity, but also a huge challenge, more so when the guys want to play in the global space. So just complementing what my two colleagues have highlighted here.
Yeah, I mean, it's a good point. I mean, just to add to this, because recently, under President Traore in Burkina, and they've tried to be quite disruptive and take control of their asset pools and see how they can leverage them. And I think we're seeing a general trend in Africa. And also I was in Brazil for COP30 recently, where sovereign countries are taking back control of their asset pools. There's an example where Norway did that for their oil reserves, and they've got trillions of dollars of value, whereas the UK sold the rights to BP and gets 250 million a year, and that's it. So I think a lot of engagement we've got is now even at sovereign level, not just private asset holders. How do we do the same thing with sovereign assets? Now, your point around the unbanked is a good one, because when I was in Ouagadougou a while back, at most there in Niamey in Niger, 3% are banked. There was no way for them to access banking, let alone capital markets. There is a regional exchange called BVRM there that kind of deals with 8 countries in the bloc, but again, not a lot of liquidity. Now with this Iberia Gold product, for example, in a control fashion, we've distributed that, and actually there's uptick in that region quite substantially, because it's very easy for them. They're used to it. They can sign up. It's all online. And it's digital. So I think we're seeing a step change, but that's actually encouraging new distribution for product, because many of you with mining assets, or even the South African government as well with sovereign assets, now can actually harness huge pools of capital that didn't otherwise exist. And we're going to see massive opportunity over the next 18 to 24 months.
Shawn, I've got a question for you. What is the rarest commodity in Africa?
The rarest, as far as what we have the least of. This seems like a trick question, Remi. I'm going to throw
Okay,
out.
I'm going to give you the answer.
Yeah,
it's finance. Underlying to what we're saying here, I spent 25 years of my life, trading with big names in commodity, trading, grain and fertilizers and sugar. Until one day I wanted to sell some commodity to a very big client, and he said, well, join the queue, there's all the traders there. And I said, no, I've got finance. He said, come to me. and talk to my office tomorrow. Why do I work today in this sweet spot between commodity trading and trade finance? Because there is an estimate of a finance gap probably between $100 and $200 billion in Africa. I mean, the small mid-market SMEs, are not financed, by the traditional financiers. The banks, they've got their own deals, bigger ticket. They have as well, had a huge. Yeah, this is done, I think. Hello. They have a huge reversal in terms of risk appetite over the past few years. We've seen a lot of European banks deserting Africa. So today, for underlying to what we're saying as well, there is this huge opportunity. It's nearly an arbitrage, for private credit, and either from a digital point of view or from a traditional point of view, to basically tackle this problem and provide basically solution for these smaller, well-managed traders or in Africa, exporters, processors who needs, $5 million and they need it in the next 3 months, not the next 3 years. And today, if you look around, what are the financiers dealing with that in Africa? There's a handful, maybe 2 handful of credit funds, and that's about it, to be honest. So there's a huge opportunity to serve the market, and obviously, if we can mix that with the next wave of product technology and hybrid, products, that's going to be very exciting.
Yeah, I mean, I would second that as well, because I mean, when we started on the climate financing side. I mean, Africa alone. Annually there's a $4 trillion annual financing gap. There's lots of talk about plugging that with $1.5 trillion at COP30 when I was there in Belém. But really not enough's being done, and then all these pledges are signed, and no one's really, you're on the ground, you're doing stuff from a trading and investment perspective, but none of these pledges, or very few of them, actually materialized, right? Everyone wants to sign MOUs, and then they get the headlines, and then they forget about it. So when we've looked at this, we found actually two-pronged. It doesn't matter whether it's a capital markets instrument, like the actively managed certificates that I mentioned on the Swiss exchange, or whether it's free token form. The big opportunity is forward financing, and then there's going to be an output that ensues from the underlying commodities, whether it's the mines being mined or rare earths where it can be extracted with the right IP being extracted. But for reverse factoring, and that opportunity is massive. And so, really this adds capacity both to private financing through these public means and through the digital means as well, that public means, that traditional and digital means, and broadly grows the overall pie and opportunity.
So I just wanted to add some numbers to what my colleague was saying, because I think it's a big point that is highlighted with regards to the challenge of financing, especially the SMEs and playing in the commodity market. Just to give you some stats, 40% of Africa's GDP is based on the informal sector. Okay, these are guys hustling, SMEs, trying to scale. 44% of our GDP. So that's about, and it equates to about, believe it or not, 44 million companies. You look at the US, a mature market, 5% of their GDP is in the informal sector. A lot of enterprise, a lot of maturity. Coming to the commodity sector, just looking at a country like Ghana, in the last 10 months, $6.1 billion of gold was produced and exported by the big corporates. 8.1 billion was produced and exported by the small-scale companies. They've just wiped their VAT to incentivize the small scale to capitalize. The last statistic, in the last 5 years, Ghana has lost $11 billion worth of gold smuggled out of the country to the UAE. So the point I'm trying to highlight here, in terms of this huge opportunity for the capital markets to go to the next level, but not enough structure and finance to accommodate that. And once we get past that dilemma, as Africa playing in the global market, huge opportunity. I just wanted to add that.
But Rutendo, staying with you and maybe then going back to Remi and Hirander.
I was trying to run away, Shawn.
No, you guys make my life easy. You guys just go. But I think everyone would agree that, and you're absolutely right, like finance is the hardest thing, and that is actually what is needed. And I think the thing is, and this has been known for decades, really, and I think there has been microloans and there's been microbanks, and that has happened. So I guess the question is, like, what needs to happen, or what needs to change, or both, to actually get to the point where there is that level of financing available for the formal but also informal markets around the continent, in commodities, but also in general?
So I think, we use it broadly when we talk about innovative financing. The traditional structures of financing, and I'm looking from an Africa perspective or compared to an emerging market perspective, has to totally change. And and obviously I'm not a financing guru, and I'll let the two gentlemen, I was going to say the two gray-haired gentlemen, but one has got gray hair, the other one has got dark hair, can give a bit more insight. But I think that the traditional models of financing and investing and capital financing have to change from where they used to be. I'll give you another statistic. Every year, you've got people in the diaspora who send back money back home into Africa. That's always been happening. Last year alone, I think it's the first time that the total diaspora funds have exceeded traditional ODA and FDI investment in Africa. I think the figure was $100 billion US. Your top 5 countries, Nigeria, Egypt, Kenya. Nigeria around got 20 billion, like Kenya, Egypt got 20 billion. But why I'm highlighting this, there's a huge play of monies coming to the continent, but the traditional structures are not capitalizing and optimizing on that. And these gentlemen can unpack that a bit more. But I think my key word is that the traditional models of financing, whether it's blended finance, whether it's innovative finance, we call it what may, has to change in the new world order to accommodate the dynamics that are out there, more so on the digital landscape that is there. So I give my hospital pass to my colleagues here.
I think what we're seeing here is a privatization of finance, moving away from established, financial entities and GFI and to private hands, and there is a revolution, as we discussed, and obviously the digital element will bring a lot of, potential to it. When we think, for example, of the funds, credit funds or private debt funds, which operate in Africa, you're as an investor, or very often your minimum investment is probably $100,000, often more. So basically, we're talking of high net worth family offices and pension fund or asset managers being able to do that. The next evolution from the investor point of view is going to be tokenization of investment, which will basically allow this $100,000 to become $1,000, and you'll have the same right and the same benefits as a fund manager. You'll be able to, invest physically $1,000 or even less, and in investment scheme in Africa, and play the same role as what a bank used to do previously.
And actually, it's playing out already because, a year and a half ago, if you'd have asked me, would this happen, with us sat here, I'd have said unlikely. But when we were fortunate to come across, let's say, the Iberia gold example, and you can look it up, it's exactly what's happened, and we realized that actually the potential is huge. And rather than deal with really large mining assets, because you're treading on toes, it's actually, whether it's through a cooperative model or regional model, we're able to aggregate a large range of smaller to medium-sized mining assets with proper underlying paperwork. And once you pool those resources together with a sum of parts valuation on the individual ones and an overall valuation, it lent itself to an opportunity. And then we realized actually it was a bit too early for downstream investors, the banks that we thought were gatekeepers. You really get this market, but as you know, a lot of your peers won't necessarily be there at the level you're at because of your interest in digital. So we said, okay, the BlackRocks and these institutions will ultimately come in. Recently Larry Fink spoke about, everything should be tokenized, right, ultimately. But a lot of that is marketing again, but it's going to be a lag. The banks are gatekeepers, the asset managers are. So what we did was we went upstream to large, ultra high net worth asset owners and owners of capital. When I say capital, old school capital, but also new forms of digital capital with, the examples that we've given. And it doesn't take a lot because, we've onboarded about 70 of those, but that's led to the sand in the oyster that can make the pull. or the grit that makes a pearl. And actually, a lot of those are influential enough, so they're downstreaming that now, and that's leading to some step change. So it was incredibly difficult at first, but I think we're reaching an inflection point, or at least the start of something quite interesting.
So thank you, guys. I have one more question, but I want to make sure I am cognizant of time. Are there any questions from the audience for our panel? Before I ask my final question, but I am opening it up. Anyone? Going. All right, they're hungry, so we won't go too long. One final question. We did talk a little bit about sovereign investment, sovereign wealth funds, and I mean, there has been a big push. I mean, South Africa's talked about it, Botswana's talked about it. Some of them, countries have been able to put it forward. How has that kind of changed capital flows in Africa? And do you think, I mean, sovereign wealth funds, is this something that sovereigns should be looking to do? How should they be looking to kind of throw capital around their own economies?
Let me, try the first shot here. Yeah, I mean, definitely. We've seen in the light of the crisis I mentioned earlier on, the financial crisis and the pandemic, we've seen this sovereign fund, having a realization that they were totally at the end of the supply chain and they need to do something to go upstream. So, for example, some of the biggest trading companies today are owned by sovereign funds. Louis Dreyfus, where I worked for 20 years, they have 45 ownership by the Abu Dhabi sovereign fund. Olam Agri is owned by 80% by the Saudi wealth fund. COFCO, which is a massive trading company, is owned 100% by the Chinese government. So these are all agri and food. There might be some example on the mining and energy side, but definitely we think this sovereign fund, trying to guarantee the supply, and realizing that they can't basically rely on traders. They can't rely on shipping line. They need to own the whole supply chain from A to Z, at least partially, to guarantee basically the stability to the people.
Yeah, I mean, it's really, really interesting. I'll give you one example that's playing out actually right now. I mean, not to pick on a country, but many of you will be able to relate this to other countries in Africa as well. So take Malawi. I mean, they've just had an election recently as well. They got $1.2 billion a year from USAID, and that overnight vanished. I was in Kenya, in Nairobi, the day that also vanished, and it impacted everything from healthcare to on-the-ground NGO, community development, to everything in between, actually. There's a massive impact. Now, $1.2 billion vanishing overnight had a massive detrimental impact to Malawi, because all of a sudden they had a balance of payments deficit of around $1.2 billion. They tried to print more money. We all know what happens there. We've got Zimbabwe next door. All of a sudden, the unofficial exchange rate is twice as bad as the official, but when you go into the money markets to try and exchange local currency, it's 3 times as bad because of the middlemen. So all of a sudden, they're in this vicious cycle. But actually, they're beginning to realize sometimes, it's a blessing and a curse. Backs to the wall. How do we address this? They realize they've got a huge pool of natural assets in country, and they can start to now harness this asset pool, as you mentioned, and start to unlock value in the right sort of way. And this is actually a step change that's resonating not just in Africa, but Bolivia has discovered $500 million worth of lithium deposits as well. And elections just happened there. And I think we're beginning to see the start of a global movement that's going to create more control on the ground with the asset pools that we have. I'd like to see that in South Africa as well. We have huge potential here.
Rutendo, final word.
So I think, the reality with your sovereignty, your sovereign wealth is, the good thing is that it forces countries to play competitively in the regions they want to participate. I mean, we've seen with the Middle East, huge play on infrastructure on the African market through your DP Worlds, supported by their sovereign funds. Singapore, you can name it. But just to end with some stats, because I think it gives us a bit of reality as well to complement what my colleagues are saying. when you look at GDP wealth, African countries were not that strong. I mean, South Africa, a mature country, our GDP per capita is about plus or minus 5,000. Ethiopia, the second most populous country, is plus or minus $2,000 per capita. Singapore, $90,000 per capita. So when you go and compete against sovereign funds that are backed by such capital, it's a tough landscape to play on, but it's a reality. And the question is, how do we position ourselves to take advantage of that, but at the same time realize the reality? So for me, I think it's becoming more complex, but the more competitive it is, it really depends on the in-country government in terms of how they capitalize on that. So that's just my 2 cents back to you.
I just wanted to add something. Whatever we're discussing here is pointing towards change and new days and on this commodity stroke finance, stroke trading, stroke investment environment. There are agents who doesn't want this change. I'm going to have to name a few here. The banks, clearly, and they are a threat of seeing basically this new system bypassing them. And actually affecting enormously their bottom line. Traders, because traders don't want to make life easy for another trader. They want life to be complicated and very obscure. Obviously, the more we become transparent in terms of transaction flow, the more we open the pot to everybody. So that's quite important.
I think that leaves a great thing to talk about over lunch as well. So thank you very much to my panel. Can I have a round of applause for them? And thank you very much.